Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. About to get started. If you have any questions or topics you wish to discuss, please chat those over. We'll be happy to go through your questions and topics. All right, it looks like we're on Instagram now too. If you're on any of our channels, if you subscribe, we do go live twice a day. That'll give you a chance to see what we're talking about each day, as well as come and ask questions, etc. If you find this to be helpful as well, if you could please like and subscribe on whatever platform you're on, just to help us get the word out to other self-employed individuals just like you, that'd be great also. And again, if you have questions or topics on this topic, which today we're going to discuss solo 401k contribution calculator. We're going to go through examples for a business tax as a partnership. If you have questions, of course, on this topic, don't hesitate to chat it over and we'll go through that, or even on a different solo 401k topic. Wonderful. So what we're going to discuss today is an essential guide to retirement savings for a business tax as a partnership. What we're going to cover is contribution clarity. Discover how much you can contribute based on your self-employment income. Contribution split. Understand the breakdown between employer and employee contributions. Mega Backdoor Roth. Learn how after-tax contributions enable this powerful strategy. We're going to go through some real-time demos, step-by-step examples using actual income scenarios. So why this session is for you, you're going to learn essentially how to reach the full $70,000 or more if you're age 50 or older contribution limit. Avoid pitfalls, just gain the clarity and practical tools so that by the end, you'll have the confidence and knowledge to make your 2025 contributions and make them in a way that maximizes those contributions. So of course, today's presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So we want to start out by going through solo 401k eligibility. In terms of who's eligible to set up a solo 401k, it's going to be for a self-employed individual. So think like a solo practicing professional, CPA, attorney, etc. The key is that you're reporting earned self-employment income on your taxes with no non-owner, non-spouse, full-time W-2 employees. So for example, some of the top eligibility considerations would include, do I need a separate entity like an LLC or an S Corp? The answer is no. We have many, many individuals who operate without a formal legal entity, such as through a sole proprietorship. And that's fine as long as they're reporting earned self-employment income with no non-owner, non-spouse, full-time W-2 employees working for any business owned by that person or spouse, if any. Now, earned self-employment income, what that means is going to depend on how your self-employed business is taxed. For example, for a business taxed as a sole proprietorship, earned self-employment income is going to be income reported on Schedule C, or maybe a single member LLC taxed as a disregarded entity. Earned self-employment income is going to be income reported on Schedule C. Whereas for a business that is taxed as an S Corp or a C Corp, earned self-employment income would be income reported on a W-2 from that business taxed as an S Corp or a C Corp. For a business taxed as a partnership, earned self-employment income is income reported on line 14 of the K-1 that the individual receives from the business tax as a partnership. There's no minimum amount of earned self-employment income that you need in order to be eligible to set up a plan. But of course, your ability to contribute to the plan is going to be a function of your earned self-employment income. So if you don't have a big amount of earned self-employment income, you wouldn't be able to contribute a relatively high amount either. Your spouse or business partner can participate as long as your spouse or business partner are reporting their own earned self-employment income. You can set up a solo 401k even if you have a W-2 day job, even if you participate in your W-2 employer sponsored plan, as long as you've got that separate earned self-employment income. Now, what we want to do today is we want to use our contribution calculator and go through some live examples so you can see how it works. So for example, if you go to our website, mysolo401k.net, and then under Learn in the menu that goes left to right, Home, About, Solo 401k, go over to the right under Learn. There's a drop-down menu. Click on Online Tools. That'll pull up this page, or that'll pull up this page where you can then click under Solo 401k Annual Contribution Calculator. If you click where it says click here, that'll pull up our contribution calculator. Now you'll enter your age, the self-employment income from your self-employed business, how your business is taxed. So we would choose partnership, the year. So now let's start to fill this out with some live examples. So to set the stage for our discussion with the live demo here, it's going to be good to understand how the contribution rules work. So your ability to contribute to the solo 401k depends on different factors. One factor is your age. So for example, if you're age 50 or older, you're going to be able to make additional, what they call catch-up contributions. Another factor is whether you participate in another plan, like a day job plan. Another factor is the type of contribution that you're looking to make. So our solo 401k plan allows for all types of contributions, whether employee or employer, pre-tax, Roth, or voluntary after-tax. And then, of course, your self-employment income. So self-employment income, how you determine that depends on how your business is taxed. So for example, for a business that is taxed as a partnership, that means that there are multiple owners that are receiving a K-1 from the business taxed as a partnership. So self-employment income is reported on line 14 of your K-1. And then you need to run a pre-calculation. Specifically, you take your line 14 income less 1/2 of the self-employment tax, and that is considered to be self-employment compensation. That's the number that's used to determine how much you can contribute. Now, of course, you're not going to be able to use W-2 wages from other sources like a day job. You also can't use passive investment income to justify contributions. It's got to be based on that earned self-employment income. So here's a good visual slide as it shows that to calculate self-employment compensation for a business tax as a partnership, you use line 14 code A of Schedule K-1 that you receive from your business tax as a partnership, less 1/2 of the self-employment tax. And we'll see when we look at the calculator that that calculator is going to run that number for us. In other words, it's going to determine 1/2 of self-employment tax. So when we enter the income in the calculator, we're going to take the amount from line 14 code A of the Schedule K-1. So to illustrate how the calculator works, we want to go through a few scenarios. So we're going to first lay the foundation with the baseline scenario, and then we're going to change different factors and see how it impacts how much we can contribute. So our baseline scenario is a self-employed business, taxed as a partnership. We're just going to assume that there's one participant in the solo 401k who's under 50 years of age, does not make contributions to another plan like a day job plan. Their goal is to maximize pre-tax contributions first, and then make any additional contributions as either a Roth and or voluntary after-tax contributions. So let's assume, for example, that this individual, and let's pull up a spreadsheet to help us see how the math works. So we've got business tax as a partnership, age under 50, no contributions to another plan, like a day job plan. Let's assume that they want to first make pre-tax and then Roth or mega backdoor Roth. Let's assume that their line 14 K-1 income is $100,000. And let's blow this up a little bit so we can really see it. So I'm going to format the cells just to make it easier to read. Okay, so so again, you got the partnership, under age 50, no contributions to another plan like a day job plan. They first want to maximize pre-tax contributions, and then whatever else they can make based on their self-employment compensation the limits they want to make is either a Roth or a mega backdoor Roth contribution. We're going to assume they have $100,000 on line 14 of their K1. So now we need to know, okay, well, what's 1/2 of the self-employment tax? That'll help us determine self-employment compensation. And then from there, we'll be able to figure out, okay, how much can I contribute as an employee? How much can I contribute as an employer? How much can I contribute as a voluntary after tax? So the calculator is going to help tremendously. So let's assume that they're 45, because again, they're under 50. $100,000 of self-employment compensation reported on line 14 of their K1. So the calculator then determines that 1/2 of the self-employment tax is $7,064.78, which means that their self-employment income is $92,935.23. So that's the number that will be used to determine how much they can contribute. So for 2025, and here the year is 2025. For 2025, the employee limit is 100% of self-employment compensation, dollar for dollar, up to $23,500. Now that employee limit is reduced by contributions made to another plan like a day job plan. But here we're assuming that the individual did not make any other contributions to a day job plan. So that means they're going to be able to contribute the full $23,500 to their employee bucket of their solo 401k. And we're going to, they can make that as a pre-tax contribution. Remember, that's their primary goal here, pre-tax. Now, and the calculator shows the maximum 401k deferral, also known as employee contribution, is $23,500. So you get this printout with the PDF, gives you the numbers. Now, they're also going to be able to contribute an employer contribution equal to 20% of that same $92,935.23 figure. In other words, line 14 of their K1 less 1/2 of the self-employment tax. That's self-employment compensation. They can make an employer contribution equal to 20% of that figure, and the calculator runs that, 18,587.05. So that would also go into the pre-tax bucket. Now, so that means between employee and employer contributions, this individual has contributed 42,087.05 in total pre-tax contributions. But they're not done yet, at least if they set up the plan with us, because our plan is going to allow for additional voluntary after-tax contributions. So they filled up the employee, they filled up the employer, but they've got additional self-employment compensation that's going to justify voluntary after-tax contributions. So our plan allows for making that voluntary after-tax contribution and then transferring those voluntary after-tax solo 401k funds to either a Roth solo 401k or Roth IRA. So that's what they call a mega backdoor Roth. Now, the voluntary after-tax solo 401k contribution limit is 100% of self-employment compensation, dollar for dollar, up to the overall limit, which here the self-employment compensation is greater than the overall limit, but reduced by other contributions made to the plan. So obviously you got to consider the overall limit, right? The sum of employee, employer, and voluntary after-tax contributions cannot exceed the overall limit. So that means they can contribute the difference up to $70,000. So $72,000 less employee and employer, that equals $27,912.95. Now the calculator's printout doesn't address voluntary after-tax, but you can see you can easily determine, and then that can be then transferred to a Roth. So that's our first example. Let's go through a few more. Our next example is the same scenario, but we're going to tweak it. So instead of $100,000 of self-employment compensation, let's assume that it's $50,000. So it's still someone who's has a business tax as a partnership. They're under age 50. They're not making contributions to another plan like a day job plan. So that's the same. They want to first maximize pre-tax, then make additional contributions as Roth and or mega backdoor Roth. They're trying to make contributions for 2025, but let's assume that they have $50,000 of line 14 income. In other words, self-employment income on line 14 of their K1. How much can this person contribute? Well, we first need to run that pre-calculation to determine 1/2 of self-employment tax. And then from there, we can determine, okay, what's self-employment compensation? So the calculator gives it to us quickly. It's $3,532.39. So if you take 50,000 less 1/2 of the self-employment tax, that means our self-employment compensation is $46,467.61. So this individual is going to be able to make $23,500 as a pre-tax employee contribution for 2025. And that can go directly to the pre-tax, right? 100% of their self-employment compensation, dollar for dollar, up to $23,500. Now they can make an employer contribution equal to 20% of their self-employment compensation. And the calculator runs that number, 9,293.52. So that's also going into the pre-tax bucket. So their total pre-tax here is going to be the sum of that employee and that employer contribution. So let's sum that up so we can see what that looks like. So that's the $23,500 plus that employer contribution for a total of $32,793.52. Now, they still have additional contributions that their self-employment compensation would allow for if they have a plan like ours that allows for voluntary after-tax contributions. And then they could transfer those voluntary after-tax solo 401k funds either to a Roth IRA or a Roth solo 401k, the so-called mega backdoor Roth contribution. So the voluntary after-tax solo 401k contribution limit is 100% of the self-employment compensation, not to exceed the overall limit. So this is a good example as it shows that they're not going to be able to go all the way up to 70. So the most that they can contribute between all different types is their self-employment compensation. In this case, $46,467.61. So they would take that amount, less the employee, less the employer, which means they could contribute another $13,674.09 as a voluntary after-tax. Okay, great. So now let's go to a third example, a third variation. So in this case, we're going to go back to someone that has $100,000 of self-employment compensation, under 50 business tax as a partnership. They first want to maximize pre-tax contributions and then make any additional contributions that are allowed as either a Roth or voluntary after-tax. But here the difference is that they've maximized contributions to their day job plan. So we're going to hide the results here just to make it easy. So we're back to somebody who is business's tax as a partnership. So that's the same. Under 50, that's the same. They have made $23,500 as a employee contribution to their day job 401k plan. Now, if that day job plan was a 403b, you'd have to aggregate all types of contributions, whether made to the 403b, whether by employee or employer, together with any contributions that they want to make to the solo 401k, and the sum cannot exceed the overall limit. But here we're assuming these are contributions made to a day job 401k, not a 403b. And their goal is to first maximize pre-tax and then make any additional as Roth or mega backdoor Roth. Again, we're assuming that it's for year 2025. They've got $100,000 of self-employment compensation or $100,000 of line 14 K1 income, which after you reduce it by 1/2 of the self-employment compensation, we already know that number. We calculated it from our first example. That's $92,935.23. Okay, so now that we've set the stage, let's determine how much they can contribute to the plan. So they're not going to be able to make any employee contributions. Why? Because they already maximized their employee contributions to their day job plan. So that's done. But they can make that same employer contribution because the employer contribution limit is not reduced by contributions made to a day job 401k. If it was made to a 403b, then yes, you'd have to aggregate, but not to a 401k. You'd have to just aggregate. It wouldn't necessarily reduce how much they could contribute as an employer, but you just have to make sure that the total amount of contributions, whether employer and 403b contributions, don't exceed the overall limit. But that doesn't apply here because we got a day job 401k plan. So that means that they're going to be able to contribute the same amount as an employer contribution, the 18,587.05. Now, let's talk about after tax. So the voluntary after tax contribution limit is not reduced by contributions made to the day job plan, unless it's a 403b, but here we're talking about a 401k. So that means this person is going to be able to contribute 100% of their self-employment compensation, dollar for dollar, up to the overall limit as a voluntary after tax, but just reduced by the employer contributions that were made to the plan. And since their self-employment compensation is greater than the overall limit, it's greater than $70,000, they could contribute potentially up to $70,000. So you would take $70,000 less that employer contribution, and the difference is $51,412.95, which could be made as a voluntary after tax. So between their two plans, their day job plan and their solo 401k, they're actually contributing more than $70,000. Okay, great. So now let's go to one final scenario. So we're, again, a business tax as a partnership. The person's under age 50. Here we're back to saying does not make contributions to another plan. They got $100,000 of self-employment compensation, or I should say $100,000 of line 14 K1 income. But their goal is to maximize only Roth or voluntary after tax. So how does that change? So let's go through an example on the Excel doc. So again, it's a partnership. That's the same. Under age 50, that's the same. Doesn't make contributions to a day job plan. That's the same. Their goal is to make Roth and or mega backdoor Roth, so they're not interested in making pre-tax. They've got $100,000 of line 14 K1 income. So we know already what one half of self-employment tax is. We know already what self-employment compensation is. They want to do it for 2025. But so the difference now is that they want to only make Roth and or mega backdoor Roth contributions. So they're going to make that same $23,500 employee contribution, but now that's going to go directly to the Roth. They're going to skip making the employer contribution, because even though our plan does allow for employer contributions to be made as Roth contributions, in our experience, most customers would choose to simply skip to make the employer contribution and simply make the difference as a voluntary after-tax contribution. So they're going to be able to contribute the difference up to $70,000 less that employee contribution. In other words, $46,500 as a voluntary after-tax, which could then be moved over to the Roth solo 401k. So at the end of the day, they'd have $70,000 in their Roth solo 401k, which was made as contributions for 2025. Okay, great. Well, hopefully you found this to be helpful. If you, again, are finding this to be helpful, we'd really appreciate if you could like the video on whatever channel you're watching on, whether on Instagram or on LinkedIn or X or YouTube. That'll really help us to get the word out to other freelancers and solopreneurs just like you. As you might imagine, there's a growing number of self-employed individuals who might find this information to be helpful. For example, as they're trying to catch up on their retirement savings goals. We also want to highlight other resources that we have. So we have our community. We've got over 30,000 members in our community. It's a vibrant community. People are posting in forums. We've got a library of videos and webinars. We've got the industry's first AI, solo401k.ai. It's totally free to join, totally free to use. It's a great way to quickly find answers to questions and other resources. So you're welcome to, again, use it at solo401k.ai. All right, with that, let's take a question. Thank you for bringing it. How do you fund a voluntary after-tax contribution? Is it done at the source of pay on the employer side, or should it be done at any time directly from the employee's personal account? Great question. So from a solo 401k perspective, there's no requirement that it come from either the employer bank account, in other words, the self-employed business bank account, or the employee bank account, in other words, the solo 401k owner's personal bank account. It can come from either account. What's more important from a solo 401k perspective is that it's made within the limits by the deadlines to a separate voluntary after-tax account. And we help our customers through those mechanical steps. Now, I would note that it is an employee contribution. So one's accountant may prefer that it come from the employee's account, but we can't say from a solo 401k perspective that it has to be made from that account. It's also noteworthy that it doesn't need to go through payroll, right? After-tax contribution doesn't need to be reported on the personal tax return or the business tax return. So it's made on an after-tax basis. It's not reported on the personal or business tax return. It's deposited into the separate voluntary after-tax account. And then it's moved from the voluntary after-tax account either to a Roth solo 401k or a Roth IRA. Now, there is a deadline to make the contribution, that first step, right? It's really a two-step process. You first deposit to the voluntary after-tax account before it's moved to the Roth solo 401k or Roth IRA. There's no deadline, though, to move it from the after-tax account to the Roth solo 401k or Roth IRA. But when you move it, that move is reportable on a 1099-R for the year of the move. And we handle that as an optional free service. Now, we don't have access to our customers' accounts, but they just simply let us know. There's a form on our website that they use. They can use it 24/7. Once they've made that move, that transfer, they can submit that online form to have the information added to the queue. So their plan is added to the queue for us to be able to prepare that 1099-R, which again, we handle as an optional free service for our customers. In other words, no additional charge. Great question. Thank you so much for bringing it. And thank you so much for the participation. Please continue to participate. We go live twice a day, once at 10 a.m. Pacific, 1 p.m. Eastern, back again in the afternoon at 1 p.m. Pacific, 4 p.m. Eastern. If you subscribe to our channels, you'll get notifications of when we go live. So you can jump on, you can see what we're talking about, you can come and ask questions. We appreciate the chance to engage on these topics. So thank you so much, everyone. Until next time.